Hello and welcome to the fixed income securities of the NISM. So let's start with the chapters. The first chapter is overview of the Indian debt market. Then chapter 2 is types of fixed income securities. Chapter 3 is risk associated with investing in fixed income securities. Chapter 4 is pricing of bonds. Chapter 5 is yield measures and total return. Chapter 6 is term structure of interest rates. Chapter 7 is measuring interest rate risk. Chapter 8 is Indian money market. Chapter 9 is government debt market. Chapter 10 is corporate debt market. So let's start with the chapter number 1, that is overview of the Indian debt market. The learning objectives are, after studying this chapter, you should know about role of debt markets, importance of debt markets, bond market ecosystem, role of regulators, role of credit rating agencies, role of monetary policy in debt markets, evolution of debt markets, market dynamics. Debt is a concept of IOU in which the receiver of the favor is willing to return the favor with the agreed rate of return for using the favor for the time period. In simple terms, Mr. A is borrowing some money X from Mr. B for 3 months with a promise to pay back X plus delta. The delta is calculated as a percentage or rate of return on the principal X. For example, delta equals to X multiply R percent multiply 3 upon 12, where R percent is the annual rate of interest agreed to be paid for the use of principal amount X by Mr. A. In this example, Mr. A is the borrower, Mr. B is the lender, and R is the agreed rate of interest expressed as percentage per annum, and time period is 3 upon 12 years, that is 3 months. To make the process formal and enforceable, Mr. A can give in writing a note that he would return the borrowed principal money X to Mr. B after 3 months with the agreed rate of interest at R percent per annum. Simply put, we can state that the note given by Mr. A is treated as a debt instrument or a tradable security. Mr. B can assign the same to someone against appropriate payment before 3 months. If he requires liquidity and wants to exit the transaction, Mr. A here is the issuer, Mr. B is the investor, R is the yield or rate of interest on the date of transaction for the borrowed time. Here that is 3 months. The tradable instrument is called negotiable instrument as necessary. Stamp duty is also being paid to the concerned authorities at the time of issuance for ensuring the enforceability of the contract in the appropriate court of law. The tradability of the instrument increases liquidity in the market and provides an exit route to Mr. B. Here, Mr. B, as investor, takes a default risk or credit risk on the promise made by the issuer. Mr. B, in the note, if the note is tradable, it becomes a security with the maturity, the date by which Mr. A has promised to pay back the borrowed funds with promised rate of interest. Debt refers to obligation of repayment of borrowing by a legal entity such as an individual, a corporate firm, or a government. Debt is raised by selling bonds, bills, and/or notes, also known as instruments, to creditors with a promise of repaying the principal amount and periodic returns or interest on the principal. Debt instruments generally have a fixed timeline. From accounting perspective, debt is an asset for the investor and is a liability for the borrower. Borrowing funds through the issue of debt instruments helps entities with a large financing requirements, as a single creditor may not be able to provide such as large amount of money. Creditors may also prefer tradable debt instruments that can be sold to meet their own liquidity requirements as well as to manage the risk on their credit exposures. These instruments also provide an opportunity to investors with surplus liquidity to earn returns. leading to the evolution of the debt markets. The debt market refers to the market where buyers and sellers trade in various debt instruments. The development of a vibrant uh, debt market is essential for a country's economic progress, as the debt market helps to reallocate resources from savers to investors. That's it for now. We will cover the next uh, part of the chapter in next video.